I think we've got two of those already back, and we're bringing the third airplane back. They have, in fact, stopped taking delivery of aircraft due to the tariff environment.
When Boeing CEO Kelly Ortberg announced that the company would be relocating its headquarters and significant operations abroad, the declaration sent shockwaves through boardrooms, trading floors, and legislative halls alike. It was a decision born of compounding pressures: newly imposed tariffs by the U.S. administration under President Donald Trump, reciprocal duties levied by key trade partners in retaliation, and the soaring costs that followed, which made cross-border supply chains prohibitively expensive. Ortberg's revelation was not a mere corporate reshuffling. It was a seismic strategic pivot that encapsulated the shifting tides of global trade politics and the fraying confidence in America's position as the world's premier manufacturing hub. Before we start, hit the like and subscribe buttons for more exclusive news. The announcement itself was succinct yet astonishing. Ortberg outlined that, effective immediately, Boeing would begin the operational transition of its executive offices, research centers, and certain production lines to a European financial center with business-friendly tax laws and proximity to crucial aerospace suppliers. He emphasized that while the United States would retain major defense contracts and some manufacturing capabilities, the lion's share of the company's commercial aviation division, its R&D labs, customer service headquarters, and Airbus competing design teams would now flourish in a jurisdiction where tariffs were not a looming threat. Industry analysts watching the live webcast struggled to reconcile the very name Boeing, synonymous for decades with American ingenuity, with a blueprint that increasingly spread across borders. At the heart of Ortberg's calculus was the Trump administration's sweeping policy of tariff imposition against major trading partners, a campaign promise invoked in stark relief. The new president had deployed punitive duties on steel and aluminum, then expanded to native goods ranging from aerospace components to precision machinery. The official rationale echoed protectionist appeals: safeguard American jobs, reduce the trade deficit, and correct what was portrayed as long-standing foreign exploitation of U.S. markets. Yet in practice, those policies ignited a volley of countermeasures. The European Union slapped levies on U.S.-made aircraft. Canada imposed extra duties on jet engine parts, and Asian partners mirrored these retaliations with restrictions that crippled the cost efficiency of sourcing American technology. Suddenly, buying key components stateside became an exercise in budget overruns, and selling finished aircraft back into world markets meant absorbing steep tariffs that chipped away at profit margins. For Boeing, a company whose sprawling supply chain extends through more than 70 countries, the ramifications were immediate. Suppliers in Ohio, Texas, and Kansas faced a dilemma: either hike their prices to cover tariff expenses, risking loss of contract to foreign competitors, or operate at a loss. Conversely, European and Asian suppliers found their products more competitive in global tenders, positioning Boeing's U.S. factories at a disadvantage even within its own corporate family. Ortberg's team conducted an unblinking review of every segment of production. The verdict was stark: continue in America under the new trade regime and accept long-term margin erosion, or pivot to Europe, Asia, or the Middle East, and regain cost parity. The decision to leave was, in many respects, a survival tactic. Behind the scenes, Boeing's internal debate was intense. Some executives argued that relocating abroad would alienate the company's domestic workforce and provoke a political firestorm. Others countered that the scale of financial bleeding was such that a reprieve could not be engineered through lobbying alone. Reports from internal memos detailed that monthly tariff costs were edging toward hundreds of millions of dollars. With profit warnings already issued for 2 consecutive quarters, the board grew anxious that the company's credit rating might be at risk. Allowing domestic tariffs to stand unchallenged, they feared, would erode investor confidence and jeopardize pension obligations. The urgency to act had reached fever pitch. Ortberg's announcement touched a raw nerve in the corridors of power. Lawmakers on Capitol Hill denounced the move as a betrayal of American workers, and congressional hearings were swiftly convened. Senators upbraided Boeing's leadership for having the audacity to threaten flight from the very soil that had nurtured its rise to aerospace dominance. In turn, Ortberg's team had to defend their position, arguing that the decision was not made in haste but was enforced by the government's own policy choices. The dispute crystallized a broader question of whether America's grand industrial champions could remain competitive under an aggressive tariff regime designed to reshape trade balances. Yet, beyond the political theater, the strategic implications of Boeing's departure were profound. For one, the shift threatened to weaken the domestic research ecosystem. Universities and defense labs that had once enjoyed direct partnerships with Boeing faced the prospect of diminished collaboration and funding. Graduate students eyeing careers in aeronautical engineering might have to relocate abroad to follow Boeing's labs, creating a potential brain drain at a time when the U.S. seeks to maintain its leadership in advanced manufacturing. Moreover, key suppliers specialized in composite materials and avionics software, many of which were small and deeply integrated into regional economies, could find their customer base decimated or forced to follow Boeing's exodus, fracturing established industrial clusters. From an international trade perspective, Boeing's move signaled to other multinational firms that reliance on the U.S. market was no longer bulletproof. When a company as emblematic as Boeing could find itself hamstrung by retaliatory tariffs and decide to uproot its operations, it underscored the fragility of global trade networks in the face of escalating protectionism. Competitors, notably Airbus and emerging Chinese and Russian aerospace firms, stood to gain significant advantage. Airbus, headquartered in Toulouse but with operational hubs throughout Europe, would benefit from reduced competition on its home turf, potentially winning contracts at lower prices. Meanwhile, the Chinese state-owned aviation conglomerates, supported by government incentives, could seize market share among price-sensitive buyers, further diversifying the competitive landscape. Another dimension was the message sent to foreign governments. Countries that had imposed retaliatory tariffs now faced pressure to reconsider their stances, lest they drive away foreign direct investment. Diplomatic backchannels buzzed with urgency as trade diplomats scrambled to negotiate exemptions or moratoriums to prevent Boeing and other manufacturers from following suit. In turn, the White House confronted the irony that its protectionist gambit was prompting a reorganization of American manufacturing footprints. If followed to its logical conclusion, this trend could hollow out the U.S. industrial base, undermining the very economic resilience the tariffs were intended to strengthen. The economic calculus was equally stark for supply chain partners. Major suppliers in the Midwest confronted the prospect of losing Boeing as a primary customer, threatening to disrupt local economies. One major actuator manufacturer disclosed that over 80% of its revenues were tied to Boeing contracts. With those in jeopardy, such companies faced decisions about whether to diversify their customer base, retool factories, or even downsize. The ripple effects reached beyond aerospace. Regional banks feared credit defaults, and municipal budgets projected shortfalls as payroll taxes declined. The decision to relocate resonated through countless balance sheets, forcing entire communities to reckon with sudden economic uncertainty. Beyond immediate economic effects, the geopolitical narrative took on fresh contours. Boeing's pivot suggested that economic policy could override decades of national security considerations. For many decades, Boeing's strong domestic presence had been viewed as essential to America's defense readiness. Its fighter jet production lines and missile systems were deemed non-offshoreable, shielded from relocation by national security constraints. Yet Ortberg's announcement implied that even those arguments might not withstand the financial strain of tariffs. If critical defense manufacturing could be nudged or compelled overseas, the security implications were profound. Reliance on foreign jurisdictions for sensitive technologies risked vulnerabilities in times of crisis. In contrast, nations vying to attract Boeing's relocated operations stood to reap considerable benefits. European governments dangled tax incentives, grants for R&D facilities, and streamlined regulatory pathways. Some Middle Eastern states offered to develop bespoke aerospace parks, complete with infrastructure tailored to Boeing's specifications. Within days of Ortberg's announcement, several governments reportedly submitted formal bids to host new Boeing campuses, pitching the promise of regulatory stability and tariff exemptions. For those nations, landing Boeing's intellectual talent and production capabilities could catalyze their own aerospace industries and elevate their positions in the global supply chain. Public reaction was polarized. Labor unions and worker advocacy groups in the U.S. criticized the administration's tariff policies for forcing companies' hands. Conversely, some segments of public opinion celebrated what they viewed as a counterattack on corporate fat cats, interpreting Boeing's departure as evidence that the company's leadership lacked loyalty to American labor. Editorial pages wrestled with the conflict between protecting domestic industries and maintaining open trade. Commentators noted the paradox of protectionist measures leading to offshoring, a cautionary tale about the unintended consequences of trade wars. On financial markets, Boeing's shares experienced extreme volatility. The initial announcement triggered a sharp sell-off, as investors weighed the potential loss of domestic revenue against the prospects of streamlined operations abroad. Equity analysts rushed to revise earnings forecasts, forecasting a transitional period of higher capital expenditures, relocation costs, severance packages, and setup of new facilities, offset by longer-term operational savings. Some recommended buying the dip, arguing that once Boeing completed its transition, the company would emerge leaner and more competitive. Others cautioned that the reputational damage and political backlash could weigh on future government contracts, keeping the stock under pressure. Beyond the balance sheets, strategic foresight offices in multinational corporations took notice. Boeing's decision served as a high-profile case study in corporate risk management under geopolitical friction. Boards across industries reassessed their own exposure to tariff regimes, reevaluating the distribution of their supply chains. Many commissioned reviews on the advisability of diversifying manufacturing sites to reduce vulnerability to any single government's policy shifts. The broader lesson was clear. In an era of resurgent economic nationalism, corporate agility and geopolitical hedging mattered as much as technological prowess. Yet the human dimension often got lost amid the broader geopolitical and financial analyses. Thousands of Boeing employees, engineers, administrative staff, technicians, faced anxiety about their careers. While Ortberg pledged transitional support and relocation assistance for those willing to move, many employees with deep roots in their communities confronted wrenching personal decisions. Will they uproot families, seek new opportunities locally, or face unemployment? Local civic leaders scrambled to propose incentives for other businesses to absorb the displaced workforce. But the uncertainty loomed large. In boardrooms of rival companies, the move inspired a flurry of strategic discussions. Airbus, emboldened by Boeing's retreat, accelerated plans to expand its own R&D footprint. State-owned aerospace firms in Asia explored partnerships to capture former Boeing clientele. Even smaller regional jet manufacturers sensed opportunity, positioning themselves as less politically exposed alternatives. The competitive landscape readjusted almost in real time, with Boeing's pivot catalyzing a wave of alliance talks, merger rumors, and partnership proposals. Critically, Ortberg's decision raised fundamental questions about the relationship between government policy and corporate strategy. It laid bare the trade-offs companies face when governments, in pursuit of national objectives, impose regulations that inadvertently harm domestic economic actors. The situation illustrated how businesses could respond by voting with their feet, relocating to jurisdictions where the policy environment was more predictable and financially sustainable. In that sense, Boeing's departure was more than a corporate relocation. It was a statement on the limits of economic nationalism in a deeply interconnected global economy. Beyond the headlines and corporate boardroom skirmishes, Boeing's decision to relocate abroad also heralded a profound recalibration of global risk management paradigms. No longer could multinational corporations treat government policy as an abstract backdrop to financial forecasts. Instead, public policy had become a direct and immediate line item in every quarterly outlook. As other firms observed Boeing's pivot, they began constructing internal war games designed to stress-test balance sheets against a spectrum of tariff and regulatory scenarios. Finance teams that once focused almost exclusively on currency hedging and commodity price fluctuations now devoted entire desks to modeling the fiscal consequences of punitive trade measures. The new playbook for corporate resilience would necessarily blend macroeconomic intelligence with geopolitical forecasting, as businesses accepted that policy shifts in capitals like Washington could instantaneously reorder global value chains. This shift in corporate orthodoxy had cascading effects on professional services. Consulting giants and boutique advisory firms saw a surge in demand for geopolitical strategy offerings, guiding clients through the labyrinthine choices of jurisdictional risk, tax regimes, and trade alignments. Law firms quickly staffed up trade law practices, anticipating a flood of appeals to domestic courts and the World Trade Organization. Investment banks re-evaluated the merits of cross-border mergers and acquisitions, wary that post-deal synergies might evaporate if political winds turned hostile. Even accounting standards groups rushed to issue clarifications on how to reflect tariff-induced cost increases and relocation charges within financial statements. In short, the ripple from Boeing's catalyst had spread through the entire ecosystem of professional advisors, redefining the contours of strategic consulting. Meanwhile, in the realm of academia, business schools rewrote portions of their curricula to incorporate case studies on Boeing's realignment. Professors of international business assigned students to debate the ethics and economics of voting with your feet, the practice by which companies relocate to more favorable policy environments. Economists argued vigorously over whether tariff-induced offshoring constituted rational economic behavior or a troubling abdication of corporate social responsibility. Scholars of political science scrutinized the episode as a cautionary tale of protectionism gone awry, while legal academics examined the interplay between sovereign immunity and the enforceability of investment treaties. The classroom, too, felt the tremors of Boeing's decision, as a generation of future executives grappled with trade-offs that extended far beyond profit and loss calculations. On the ground, labor markets in targeted regions underwent their own metamorphosis. European and Asian talent pools that once flirted with short-term assignments or liaison roles now contemplated permanent transfers to join Boeing's nascent overseas campuses. Recruitment agencies reported an uptick in demand for aerospace specialists fluent in both engineering disciplines and multinational compliance protocols. Language schools found a renewed purpose as professionals sought to master the lingua franca of jurisdictional negotiation, whether English with European inflection or Mandarin with technical precision. The global mobility of highly skilled labor, often romanticized in idealistic terms, was now propelled by stark economic imperatives, illustrating how shifts in trade policy could reorder human capital flows. Simultaneously, environmental considerations took on newfound prominence in the conversation around Boeing's cross-border realignment. With Europe's stringent carbon emissions regulations and Asia's varied environmental standards, the company faced the delicate task of harmonizing its green strategies across multiple jurisdictions. Sustainability officers had to recalibrate supply chain footprints to meet the toughest environmental criteria among host countries, lest Boeing risk being accused of forum shopping for lax standards. Critics in environmental circles warned that such a diffusion of operations might complicate accountability for emissions and waste management. Boeing, in response, rolled out a unified global environmental charter designed to impose a floor under its sustainability practices, regardless of local regulations, a move that underscored how public policy upheavals could trigger more robust corporate governance frameworks. Financial markets, meanwhile, continued to grapple with Boeing's new reality. Bond investors, who had initially balked at the company's credit spreads widening in the wake of the announcement, gradually came to see the relocation as a hedge against the very policy risk that had spooked them. Credit rating agencies appended special commentary to their reports, noting that while transition costs and political backlash posed near-term challenges, the geographic diversification could bolster Boeing's long-term resilience. Equity derivatives desks loaded their models with new volatility parameters, effectively embedding the probability of further tariff escalations into option prices. The sophistication of these financial adjustments signaled a broader recognition that corporate domicile decisions now lay at the nexus of capital markets and political risk assessment. The phenomenon was not confined to the corporate world. Venture capital and private equity circles were similarly attuned to the implications. Investors scrutinized portfolios for exposure to trade policy vulnerability, wary that a sudden imposition of duties could undermine the business models of startups dependent on cross-border components. Funds specializing in industrial technology began to include clauses in their term sheets that permitted revaluation or exit should foundational suppliers undergo major jurisdictional shifts. In some cases, VC firms even revise their geographic allocation strategies, favoring companies domiciled in stable regulatory environments. Boeing's high-profile relocation thus injected a dose of caution into the venture ecosystem, compelling investors to view global trade policy as a strategic factor in early-stage due diligence. Beyond financial ripples, the relocation sparked legal debates over jurisdiction and governance. Boeing's Byzantine corporate structure, already a tapestry of subsidiaries and joint ventures, would become yet more complex as the company reformed its articles of association under foreign corporate codes. Corporate law scholars pondered how shareholder rights, director liabilities, and merger controls would differ under European Union directives or Asian regulatory edicts compared to U.S. Securities and Exchange Commission oversight. Litigation risks spiked as activist investors and pension funds explored whether Boeing's management owed them fiduciary duties to resist relocation. Meanwhile, antitrust authorities in potential host countries scrutinized the merger of Boeing's existing local operations with its incoming divisions, fearful that the enlarged entity could stifle competition in regional aerospace markets. Another layer of complexity emerged in the realm of intellectual property. Boeing's patent portfolio, spanning aerodynamics, material science, and avionics software, would now be stewarded under multiple legal regimes with divergent approaches to patent protection and licensing. The potential for disputes increased as licensing agreements, originally negotiated with reference to U.S. patent courts, required renegotiation or extension under foreign jurisdiction. Research partnerships with local universities and government labs would need new contractual frameworks to safeguard trade secrets and comply with export control laws. The task of reconciling these overlapping IP regimes demanded a concerted effort from Boeing's legal and R&D teams, who recognized that intellectual property was as much a geopolitical asset as a technological one. Meanwhile, the shift in Boeing's footprint had repercussions for national supply chains in host countries. Europe's aerospace clusters, already dense around Toulouse, Hamburg, and Madrid, anticipated an infusion of activity that could accelerate innovation in lean manufacturing techniques and digital twins. Asian governments, seeing an opportunity to ascend the value chain, sought to embed their homegrown suppliers into Boeing's procurement matrix, while also lobbying for technology transfer agreements. This dynamic risked creating asymmetries. Host countries eager to cultivate local aerospace champions might demand a share of Boeing's proprietary technologies as a quid pro quo for investment incentives. In turn, Boeing's executives had to weigh the financial allure of subsidies against the strategic imperative of controlling their core technologies. A parallel narrative unfolded within the defense sector. While Boeing had pledged to maintain U.S.-based production for military aircraft and missile systems, the blurred lines between commercial and defense technologies meant that the company needed robust internal firewalls to prevent cross-contamination. Export control specialists at Boeing established new zones of compartmentalization to ensure that certain design processes and software tool chains remained exclusively under U.S. jurisdiction. These measures, while necessary to satisfy the Department of Defense, added layers of operational complexity and cost. Defense contractors and policymakers alike watched this experiment closely. If global trade pressures could force the fragmentation of a defense industrial titan, what did that portend for future national security procurement strategies? Simultaneously, global aviation regulators braced for the impact of Boeing's geographic repositioning. Certification processes for new aircraft models, historically coordinated through the Federal Aviation Administration, would now necessitate parallel procedures with the European Union Aviation Safety Agency and other authorities. The multi-pronged certification strategy threatened to elongate development timelines and inflate compliance costs, as Boeing's engineers navigated overlapping requirements for safety, emissions, and noise standards. Regulatory agencies, for their part, forged new interagency pacts to streamline joint reviews, mindful that delays in certifying critical new models could ripple through airline purchasing plans and passenger travel expectations. As these regulatory gears turned, airlines themselves recalibrated fleet planning strategies. Carriers had long negotiated best value contracts with Boeing, often leveraging concurrent bids from Airbus to secure favorable terms. Now, with airplanes potentially transshipped from new manufacturing hubs around the globe, Airlines factored in variable delivery logistics and possible regional customization options. Some carriers in emerging markets, for whom cost pressures were acute, drew up contingency plans to procure small fleets from alternative manufacturers in the event of supply disruptions. Conversely, full-service airlines tightened service-level agreements with Boeing, demanding contractual guarantees around delivery schedules and spare part availability, enforced by penalty clauses to mitigate uncertainty. Concurrently, the maintenance, repair, and overhaul (MRO) sector encountered its own set of questions, with Boeing's after-sales support organization realigning to serve new geographic clusters. MRO providers located near U.S. hubs faced the prospect of reduced access to centralized inventories of genuine parts. Independent MRO shops scrambled to secure maintenance contracts and negotiate direct supply arrangements with Boeing's network, while OEM-affiliated service centers in Europe and Asia readied expanded warehousing facilities. Airlines and lessors seeking to safeguard fleet availability rates re-evaluated long-term service agreements and towing partnerships, concerned that a shift in the locus of support could elevate ground time for critical wide-body aircraft. Yet another domain touched by Boeing's exodus was trade finance. International banks underwriting letters of credit for aircraft purchases had to adjust risk assessments in light of changing collateral values and cross-border enforcement concerns. Insurers of marine transit on component shipments recalibrated premiums to reflect the increased distance and complexity of supply routes. Export credit agencies in host nations saw an opportunity to extend preferential financing terms for Boeing's deals, competing with the U.S. Export-Import Bank, which traditionally underpinned Boeing's sales with low-cost loans and guarantees. The global mosaic of trade finance thus shifted, as state-backed institutions vied for market share in financing aerospace commerce. Behind all these systemic changes lay the intangible, Boeing's corporate culture undergoing its own evolution. Once fiercely American in identity, steeped in the lore of Seattle's Puget Sound and the Midwest's industrial heartland, the company now contemplated a mosaic of cultural influences. Leadership seminars that had once celebrated Boeing's American DNA were now recast to highlight the company's emerging global citizenry. Internal communications pivoted to multilingual newsletters and cross-cultural training as employees from diverse backgrounds engaged in a shared mission. The company's philanthropic arm likewise expanded its footprint abroad, forming partnerships with STEM education programs in host communities to cement Boeing's reputation as a responsible corporate neighbor. Investor relations teams faced the daunting task of weaving this tapestry into a coherent narrative for Wall Street. Executives found themselves on an endless circuit of investor roadshows, traveling from London to Singapore to Toronto, elucidating how Boeing's strategic repositioning would ultimately drive shareholder value. Analysts grilled management on metrics tied to relocation progress, leases secured, R&D labs operational, headcount percentages abroad, and demanded granular updates on cost savings realized versus transition expenditures. The very notion of domicile metamorphosed from a fixed point on the balance sheet into a dynamic variable in quarterly disclosures. Amid this whirlwind of change, Boeing's competitors recalibrated their own growth trajectories. Airbus redoubled efforts to penetrate markets where Boeing's U.S. tariffs had once given it leverage. Regional jet manufacturers in Brazil and Canada explored partnerships with host nation governments to replicate Boeing's incentive models. Emerging OEMs in China and Russia, buoyed by state backing, sensed an opening to propose alternative aircraft platforms to airlines seeking political neutrality in procurement decisions. The global competitive landscape in commercial aviation entered an era of heightened fragmentation, as no single manufacturer could rely solely on its home country advantages. Yet, for all the complexity and upheaval, there remained undercurrents of optimism among certain quarters. For emerging aerospace clusters in host countries, Boeing's relocation promised an influx of talent, technology, and investment, an engine for local economic development. Governments saw the chance to foster inward foreign direct investment, creating high-skilled jobs and embedding themselves in a critical global supply chain. For international travelers, the prospect of more competitive aerospace ecosystems hinted at faster innovation in greener, quieter, and more efficient aircraft. Though the departure from the U.S. marked an end to a historic chapter, it also opened a new one in which aerospace excellence could flourish in multiple geographies. The question of whether Boeing's multi-homing strategy, simultaneously anchoring itself in several jurisdictions, would prove sustainable remained unanswered. The company faced the daunting task of preserving coherence in its operations, sustaining research synergies across time zones, and harmonizing quality standards on 2 or more continents. Boeing's management would need to cultivate a mindset of seamless collaboration, where an engineer in Toulouse and one in Seattle could contribute equally to a single design review. Success in this venture could reshape notions of what it meant to be a global enterprise in the 21st century. Failure could result in fractured operations and lost technological momentum. If you liked this video, please give it a like and subscribe to our channel. Also, could you leave your comments below and tell us, what are your thoughts on Boeing moving abroad after Trump's tariffs? What happens next? We want to hear from you. Thank you for watching and see you next time.